It goes back to June. In June, we had our LP meeting in London for Europe and the Middle East and Asia. And, I was up there doing the kickoff talk. And the only thing anybody wanted to talk about was, how bad will inflation get? How much will the Fed raise rates to fight inflation? And will it produce a recession, and how bad and for how long? That's all anybody wanted to talk about. So I gave a few answers. I sat down. I listened through to the other speakers that morning, had lunch. And then I got up after lunch and I said, you know what? I'm unhappy with what just happened this morning, because all those things that people wanted to talk to me about were short-term things. Recession, inflation, rates. That's not what matters. First of all, we can't know much about those things. People make predictions. They're usually wrong. Number two, because of that, if we have an opinion, we shouldn't put a lot of stock in it. Number three, if we have an opinion without much stock in it, we're probably not going to change our portfolios very much. Number four, it's not what matters. I said what matters is what we do at Oaktree. We look for companies that will become more valuable over time and bonds that will pay their interest and principal as promised. This is what matters. And we have been in a very unusual environment for most of the last 40 years. And certainly for the last 13. 40 years ago, in 1980, I had a loan outstanding from a bank, and I got a slip of paper which said the rate on your loan is now 22.25. I don't know if you remember that. 40 years later, I was able to borrow at 2.25, fixed for 10 years. That's a hell of a change. I believe it's a one-time change. I don't make predictions about the future. I don't have any confidence in them usually. The one I'm confident of is we're not going to see another decline of 2,000 basis points. I think that's over. Further, I think the period of zero interest rates is over, because you may recall that at the end of 20, only 2 years ago, when the Fed was keeping rates at zero and the Treasury was giving out all kinds of money for COVID relief and running up its deficits and debt, some of us were worried about that, but there was something around called the modern monetary theory, which said these things don't matter. And I think a big part of the lesson of the last year and a half is that they do matter, and that they produce, among other things, inflation, and that inflation can't be tolerated. So I think the Fed has to stay more balanced in the future and not have rates at 0 or 1 and prevent inflation from catching on. It's hard to extinguish inflationary expectations, as I think we'll see. It was very hard in the 70s and early 80s. I think it'll be hard, and I think that the Fed will stay with high rates and, as Powell has said, raise them gradually, but maybe for longer than most people expect. If you look at the last 13 years since the end of the global financial crisis in 2009, what have we seen? Highly stimulative Fed, which was possible because inflation was dormant, a rosy economic outlook. We had the longest economic recovery in history, very few bankruptcies and defaults in the credit universe where I work, eager buyers, happy holders. The dominant fear was FOMO, the fear of missing out. Nobody worried too much about losing money because they did count on a Fed put or something like that. Very easy to raise money. Companies could get money for any purpose. Zombies were kept in business, companies whose debt service exceeded their cash flow. And the lowest interest rates in history, narrow credit spreads, the lowest prospective returns in history for credit instruments. And that's the world we lived in since the end of 2009. And I gave a speech to clients October of 2012 until February of 2020 entitled Investing in a Low Return World. We were in a low return world, especially in credit folks and bargain hunters, and value investors suffered along with that. How was a client supposed to make a good return? Most of my clients are institutions that need something like 7. How are you supposed to make that in a low return world where cash is 0, treasuries are 1, high-grade bonds are 2 to 3, high-yield bonds are 4 to 5? And the answer is you had to push out into riskier strategies. And so we saw, in particular, enormous flows into private equity as presenting the solution. I think that we're in the process of reversing that. We don't have an expansive Fed anymore because inflation is now at a 40-year high. although I did see a headline this morning that it seems to be easing a bit. We don't have a rosy economic outlook. Most people assume that the interest rate increases that the Fed has made and will make will produce a recession within the next year or two. In this climate, there should be bankruptcies and defaults. It's not easy to raise money today, and it probably won't get easy. The banks are hung with these bridge loans, making life difficult for them. And so today we have hesitant buyers, uncertain holders, fear of actually losing money, not just missing out on returns. But today we have what I call full interest rates. I wouldn't say high, but they're not low anymore. Full, moderate yield spreads, kind of in line with history, and significant full returns on credit instruments. So I think that the world of the last 13 years is flipped. If not 180 degrees, then 140 degrees or something like that. And I'll stop by saying that if you agree that that's true, that the environment has changed dramatically, and I don't think we're going back to the old environment right away, then it stands to reason that the strategies that work best in those 13 years are not the strategies that are going to work best in the years ahead. So that's the essence of the memo. Now you don't have to read it. That's where I think we are. And the memo is titled A Sea Change because I think that this is a transformation of the environment.